Hi, and welcome back to our edition of Technically Speaking. My name is Violeta Todorova, and I'm Senior Market Analyst at Legacy FX. In the US, bank earnings this week will kick off a highly anticipated second quarter reporting season that could either mark a turning point for stocks facing their worst first half start in 50 years, or cement the case for recession or even stagflation. JP Morgan, Citigroup, Wells Fargo, and Morgan Stanley will lead the way with June quarter profit updates, and around 18 S&P 500 companies are slated to report this week. According to Refinitiv data, collective S&P 500 profits are forecast to rise by 5.7% from last year, although the bulk of those gains will be derived from soaring energy sector profits, industrials, and banks. Once those are taken out, the S&P 500 earnings will likely be 3% lower from last year. Around a third of the collective S&P 500 profit total is derived from only 3 of the benchmark's 11 sectors. At present, investors are taking a broadly defensive tone, as that's hardly the foundation from which to build a broad-based rally for stocks over the second half of the year, particularly when the Federal Reserve is committed to fight red-hot inflation. The CME Group FedWatch is pricing 93% chance of 75 basis point rate hike in July, after last week's non-farm payroll report showed the US economy created 372,000 jobs, beating market expectations. Investors fear the aggressive Federal Reserve interest rate hike could tip the already cooling economy into a recession. The market is cautious ahead of Wednesday's CPI data, which should provide a glimpse if inflation has peaked. The US Treasury bond yield curve remains inverted, adding further concerns about potential upcoming recession. The daily chart of the S&P 500 index shows the bull market from the March 2020 low has peaked in January 2022, with the index trading in a clear bear market over the past 6 months. The daily RSI indicator is below its medium-term downtrend line and firmly within its bear market range, showing that internal momentum conditions are weak and deteriorating. The daily stochastic indicator has turned down from overbought levels and points to a likely pullback in the short term. The first potential downside target is 3,750 points, followed by 3,650. Despite being oversold on a weekly basis, the current price structure of the current bear market appears incomplete, and we expect further weakness in the coming months. The potential medium-term downside target is 3,400 points. This level is a previous key resistance for the index, where strong buying interest is likely to start building up in the future. Thank you very much for tuning in. Hope to see you next time.